Picture this: 41,000 brand new condos sitting empty across Ontario. Cranes frozen in the sky, developers sweating through their suits, and the premier of Canada's most populous province watching helplessly as billions of dollars worth of real estate sits unsold with absolutely no buyers in sight. What you're witnessing right now is not just a market correction. This is a complete and total collapse of buyer confidence, and the ripple effects are about to shake the entire Canadian economy to its core. If you've been watching this channel, you know we've been tracking this housing crisis for months, but what's happening right now is unlike anything we've seen in decades. Before we dive into this incredible story, make sure you hit that subscribe button and tap the notification bell because the situation is evolving rapidly and you're going to want to stay informed as this unfolds. Let's start with the numbers because they tell a story that no politician wants you to hear. According to the latest data from Urbanation, there are now over 41,000 unsold condo units across the Greater Toronto Area and surrounding regions. To put that in perspective, that's enough empty condos to house the entire population of a small city like Stratford, Ontario. We're talking about towers that were supposed to be filled with young professionals, newcomers to Canada, and first-time homebuyers. Instead, they stand as monuments to what many are calling the greatest miscalculation in Canadian real estate history. Now, here's where it gets really interesting. These aren't just units that are taking a little longer to sell. These are condos that have been sitting on the market for months, in some cases over a year, with developers slashing prices, offering incentives, and still watching potential buyers walk away without a second glance. The absorption rate, which measures how quickly new units are selling, has collapsed to levels not seen since the 2008 financial crisis. In a healthy market, you'd expect to see around 70 to 80% of new condos sold within the first few months of launch. Right now, some projects are struggling to hit 30%, and that's being generous. So what exactly happened? How did Ontario go from a red-hot real estate market where condos sold out in hours to this wasteland of unsold inventory? The answer is a perfect storm of factors that came together at the worst possible time, and Ontario Premier Doug Ford is now scrambling to figure out a response. Let's rewind a bit. During the pandemic years of 2020 and 2021, the condo market in Ontario went absolutely insane. Interest rates were at historic lows, hovering around 2% or even less. Money was essentially free to borrow. Investors, both domestic and foreign, were snapping up pre-construction condos like they were lottery tickets. The prevailing wisdom was simple: buy now, watch the value climb, and sell for a massive profit before the building even finished construction. For years, this strategy worked beautifully. People were making hundreds of thousands of dollars without ever setting foot in the properties they purchased. Developers watched this feeding frenzy and did exactly what you'd expect. They launched project after project, breaking ground on towers across the GTA, Hamilton, Kitchener, Waterloo, and beyond. Cranes became so common on the Toronto skyline that the city earned the nickname Crane City. At one point, Toronto had more construction cranes operating than any other city in North America. The assumption was that demand would remain infinite, that prices would only go up, and that there would always be another buyer waiting with cash in hand. Then came 2022 and 2023, and everything changed. The Bank of Canada, responding to runaway inflation, began raising interest rates at the fastest pace in the institution's history. Rates went from near zero to over 5% in what felt like the blink of an eye. Suddenly, that mortgage payment that looked manageable at 2% became absolutely crushing at 6 or 7%. A buyer who qualified for a $700,000 mortgage in 2021 might only qualify for $450,000 in 2023. The math simply stopped working for millions of Canadians. But here's the part that really sent shockwaves through the market. Remember all those investors who bought pre-construction condos expecting to flip them for profit? Well, they started getting their closing notices. The buildings they bought into years ago were finally finishing construction, and it was time to take possession and close the deal. Except now the units they purchased at peak prices were worth less than what they paid. The rents they expected to collect wouldn't come close to covering their mortgage payments at current interest rates, and the buyers they hoped to sell to had completely vanished. We started seeing something that hadn't happened in the Canadian market in years: assignment sales flooding the market. An assignment sale is when someone who bought pre-construction tries to sell their contract before closing because they either can't or don't want to complete the purchase. In 2024 and into 2025, these assignment sales exploded. Investors who had paid $800 per square foot were listing their assignments at $600 per square foot, taking massive losses just to escape the deal. Some walked away entirely, forfeiting their deposits, which often amounted to $100,000 or more. The developers, meanwhile, found themselves in an impossible position. They had towers full of completed units and nobody to buy them. They had projects in the planning stages that suddenly made no financial sense. They had loans coming due with banks that were getting increasingly nervous about their exposure to the condo market. What followed was a wave of project cancellations, construction delays, and in some cases outright developer failures. Now let's talk about Doug Ford, because the Premier of Ontario is facing perhaps the most significant housing challenge of his political career, and his response so far has been nothing short of chaotic. Ford came into office promising to make housing affordable for the average Ontarian. He promised to cut red tape, speed up approvals, and get more homes built. His government set ambitious targets, talking about building 1.5 million homes over the next decade. The messaging was clear: more supply equals lower prices equals happy voters. But here's the fundamental problem with that approach. You can approve all the housing you want, but if nobody can afford to buy it, those approvals mean nothing. Ford's government focused heavily on the supply side of the equation while largely ignoring the demand side. They loosened regulations on developers, opened up greenbelt lands for development in a controversial move that was later reversed amid scandal, and pushed municipalities to fast-track projects. What they didn't do was address the fundamental affordability crisis facing young Canadians. The result is what we're seeing now: a market flooded with inventory that nobody wants at the prices being offered. Developers built for a market that no longer exists. The buyers Ford's government assumed would appear simply never materialized. First-time home buyers are priced out even at these reduced levels. Investors have fled to the sidelines or moved their money to other markets, and international buyers, once a reliable source of demand, have been scared off by taxes, regulations, and the general uncertainty surrounding Canadian real estate. The 41,000 unsold condos represent something much larger than just a real estate problem. They represent a generational failure of housing policy. They represent the broken dreams of young Canadians who were told if they just worked hard and saved, they could own a home. They represent the hubris of developers who convinced themselves the good times would never end. And they represent a premier who is now watching his political fortunes potentially crumble alongside the condo market he helped inflate. Let's dig into some more specific numbers because they really paint a picture of how dire the situation has become. The average price per square foot for new condos in the GTA has dropped significantly from its peak. In 2022, we were seeing prices north of $1,500 per square foot in desirable areas. Today, you can find new inventory at $1,100 or even lower, and that's before negotiating. Developers who swore they would never discount their product are now offering incentives that would have been unthinkable just 2 years ago. We're talking about free parking worth $60,000, waived maintenance fees for the first year, mortgage rate buy-downs, closing cost credits, and in some cases, outright price reductions of 10 to 15%. Even with all these incentives, buyers aren't biting. Why? Because the fundamental economics still don't work. A $500,000 condo with a 20% down payment still means a $400,000 mortgage. At current interest rates, that's roughly $2,500 a month, just for the mortgage payment. Add in maintenance fees of $600, property taxes of $300, and you're looking at $3,400 a month before utilities. That's over $40,000 a year just to live in a small condo. For many young professionals earning average salaries, that represents 50% or more of their take-home pay, which is simply unsustainable. The investor math is equally broken. Those same carrying costs mean you need to charge around $3,000 a month in rent just to break even. And that's with a 20% down payment. Current market rents for comparable units might get you $2,200 to $2,400. So as an investor, you're underwater from day one, losing money every single month while hoping for capital appreciation that may never come. Smart investors looked at these numbers and concluded the obvious. This is a losing proposition. They took their money and went elsewhere. What about international buyers? For years, foreign investors, particularly from China, were major players in the Toronto condo market. The government response was to pile on taxes. We now have foreign buyer bans, speculation taxes, vacancy taxes, and a general regulatory environment that signals foreign money is not welcome. Whether you agree with these policies or not, the practical effect has been to remove another source of demand from the market at precisely the wrong time. The ripple effects extend far beyond the condo towers themselves. Think about all the industries connected to real estate development. Architects, engineers, lawyers, real estate agents, mortgage brokers, interior designers, furniture retailers, appliance manufacturers, moving companies. All of these sectors are feeling the pain as the condo market freezes. Construction workers who were in such high demand just 2 years ago are now facing layoffs and reduced hours. Trades that commanded premium wages are seeing rates come down as competition for scarce work intensifies. Then there's the impact on government revenues. Development charges, land transfer taxes, and permit fees generate billions of dollars for municipal and provincial governments. When development slows, that revenue dries up. Municipalities already struggling with budget shortfalls are now facing even bigger gaps. Toronto, in particular, is dealing with a structural deficit that will only worsen as real estate activity declines. The very housing policies meant to generate tax revenue are now strangling the golden goose. Ford's government has started to respond, but critics argue the measures are too little, too late. The province has adjusted some development charge policies, offered deferrals for builders struggling with cash flow, and made noises about further streamlining approvals. But these supply-side interventions address the wrong problem. You don't solve a demand crisis by making it easier to create more supply. That's like trying to fill a leaky bucket by turning up the tap instead of plugging the hole. What the market actually needs is a restoration of buyer confidence and affordability. That means either prices need to fall significantly further, interest rates need to drop substantially, or incomes need to rise dramatically. Given the current economic environment, the most likely path forward involves continued price declines. Some analysts are predicting another 15 to 20% drop in condo values before the market finds a floor. For investors who bought at the peak, that means potentially losing half their equity or more. The psychology of the market has shifted in a fundamental way that will take years to repair. For decades, Canadians believed that real estate only goes up. Parents told their children to buy as soon as possible because prices would only be higher tomorrow. This belief became so entrenched that people took on enormous financial risk, assuming they couldn't lose. What we're witnessing now is the death of that assumption. A generation of Canadians is learning that real estate can go down, that buying isn't always the right choice, and that the market doesn't care about your financial plans. This psychological shift will have profound implications for the market going forward. Buyers who have been burned will be far more cautious. The fear of missing out that drove bidding wars will be replaced by the fear of catching a falling knife. Even when prices become objectively attractive, many potential buyers will sit on the sidelines, waiting for further declines. This buyer hesitancy can become self-fulfilling, leading to continued price weakness and extended market stagnation. Looking at comparable situations internationally provides some context for what Ontario might face. Japan experienced a real estate crash in the early 1990s that took decades to recover from. Prices in some markets still haven't returned to their peak levels over 30 years later. The United States experienced a severe housing crash in 2008 and 2009 that took roughly 10 years to fully recover from in most markets. While Canada's situation has differences from both examples, the lesson is clear. Real estate markets can stay depressed for far longer than most people expect. The 41,000 unsold condos also represent a massive misallocation of capital and resources. Billions of dollars worth of concrete, steel, glass, and labor went into creating these units. That capital could have been deployed elsewhere in the economy, perhaps in manufacturing, technology, or other productive sectors. Instead, it sits frozen in towers that may not be fully occupied for years. The opportunity cost of this misallocation is enormous and difficult to calculate, but it represents a real drag on economic growth and prosperity. For Doug Ford specifically, this crisis presents a political nightmare. He positioned himself as a builder, someone who would cut through bureaucracy and get homes constructed. But building homes that nobody can afford to buy isn't really solving the housing crisis. It's just shifting the nature of the problem. His opponents will point to the unsold inventory as evidence that his approach has failed. They'll argue that focusing on supply while ignoring affordability was always destined to end this way. The next provincial election will almost certainly feature housing as a central issue. Ford will need to explain why, after years of his pro-development policies, thousands of Ontarians still can't afford a home, while thousands of homes sit empty. That's a difficult narrative to spin, especially as the pain spreads through connected industries and affected workers find themselves unemployed or underemployed. What does this mean for regular people watching this video? If you're a renter, the silver lining in all of this is potential rent stabilization or even decline in some markets. With so much vacant inventory, landlords will face pressure to lower rents to attract tenants. We're already seeing this in some Toronto neighborhoods where rents have dropped noticeably from their peaks. If you're patient and flexible, there may be good rental opportunities emerging. If you're a potential buyer who has been sitting on the sidelines, the question becomes, when is the right time to enter the market? The honest answer is that nobody knows for certain. Prices could stabilize here, they could fall further, or we could see some unexpected factor change the equation entirely. What I would suggest is focusing less on timing the market and more on your personal financial situation. Can you comfortably afford the payments? Would you be okay if prices dropped another 10 or 20%? Are you buying to live in, or are you speculating on appreciation? Answering these questions honestly will serve you better than trying to guess where prices go next. If you currently own a condo, especially one purchased as an investment in the past few years, this is a time for realistic assessment. Look honestly at your cash flow situation. Can you sustain the losses if rents don't cover costs? What happens if prices continue declining? Is it better to cut your losses now or hold on and hope for recovery? There's no shame in admitting that an investment didn't work out, and sometimes the best move is to accept the loss and preserve capital for better opportunities elsewhere. The story of Ontario's 41,000 unsold condos is ultimately a story about assumptions meeting reality. The assumption that demand was infinite met the reality of interest rates. The assumption that prices only go up met the reality of market cycles. The assumption that government policy could engineer a soft landing met the reality of economic forces beyond any politician's control. These assumptions, held by developers, investors, and governments alike, have now collided with an unforgiving marketplace that doesn't care about projections or promises. As we wrap up this video, I want you to think about what this situation reveals about broader economic policy in Canada. We've built an economy heavily dependent on real estate. Housing construction, real estate services, and related industries account for a disproportionate share of Canadian GDP compared to other developed nations. When this sector stumbles, as it's doing now, the entire economy feels the pain. Perhaps this crisis will finally force a conversation about diversifying the Canadian economy away from this dependency. The next few years will be crucial for determining Ontario's economic trajectory. How the government, developers, and buyers respond to this inventory overhang will shape the real estate market for a generation. We may see consolidation among developers as weaker players fail. We may see creative solutions like converting some of this inventory to affordable housing or rental stock. We may see policy innovations that address the fundamental affordability challenges facing Canadians. One thing is certain: the old playbook isn't working anymore. The strategies that created fortunes in Ontario real estate over the past 2 decades are failing spectacularly. A new approach is needed, one that prioritizes sustainable affordability over speculative profits, and that views housing as homes rather than investment vehicles. Whether our political leaders have the vision and courage to implement such changes remains to be seen. If you found this analysis valuable, please take a moment to like this video and share it with others who might benefit from understanding what's really happening in the Ontario housing market.